Hi everyone, welcome to another video. So today we are going to discuss about the recent news that Jane Street is fined for $4,800 uh, by SEBI, and yeah, check my volume. This volume is good. Some brightness will keep. Okay. Yeah. Yeah. So the topic for today is the news which is in circulation recently that. Jane Street got fined by SEBI for 4,800 crores, and so we'll go through which trading strategy they got them into this fine, and we'll go through some examples of what has been done. They have deposited that 4,800 crores now, and the ban is lifted. So now Jane Street is back in the market. It's a prop trading firm, a global prop trading firm, and it's known for market making. Makes most of its money from market making. But yeah, we'll see. What how much money did Jane Street make from Indian's options market, and what percentage of this money that Jane Street made from Indian's option market is a part of their overall global revenue. Okay, yeah, let's start. So yeah, what SEBI has found is Jane Street was doing intraday index manipulation. So they were doing a pump and dump sort of thing, which is basically they're manipulating the entire index itself on an intraday basis. How you do this manipulation? What was found from SEBI's investigation is on expiry days, basically. What Jane Street was doing. You might have seen, all the recent for 3 to 4 months expiries. There is definitely a gamma blast and some wild move happening. Uh, Even in normal market days, also it happens. Okay, so what SEBI has found is on expiry days, what Jane Street was doing was, they were buying Bank Nifty constant stocks and futures. So Bank Nifty constant stocks is like HDFC, ICICI, and Kotak. Okay, so all these companies which constitute the Bank Nifty index, right? So they will buy the shares, Axis Bank. So all these, okay. So major these four are the main one. SBI is also main one. These comprise around 50%. But yeah, what they were doing is they were buying the shares of or the shares and the stocks of these Bank Nifty constant companies or futures of those companies early in the day. So they were buying this early in the day. So in the morning they'll come and they'll buy like a massive buying of all these constant stocks. What will happen then? Even in neutral markets also they'll buy it. Then what will have happen is artificially the price will go up because someone is making huge buying. The prices will go up, and this will create an artificial inflation. Okay, because the constants or prices increasing, the index also will increase. Okay, and then what will happen, this index derivatives are based on this index, right? So derivatives are something which derives their value from an underlying thing. Okay, they don't have any value by themselves. So index has this underlying constants like HDFC Bank, ICICI Bank, Axis Bank, and all the constants of Kotak Bank and SBI. All these constants constitute this index along with this weightage and based on market cap. Okay, so when you buy these stocks, okay, the what will happen is all the stock prices of this entire constants will go up. Index will also go up. Okay, uh, artificially. There is no fundamental reason for that. Uh, there is no increase in PNL, or there is no news driving that. There is no economic thing that is driving that. Not even a technical analysis thing that is driving it, or a valuation thing that is driving it. This is just money power, just inflating the index. Okay, so that's what was being done. Then what they'll do is when this index goes up, generally the short the put options will become if the market is rising up, call option will rise in value, but put option will decrease in value, right? So what they will do is they will take a, that at that time they will take a long short position. Okay, then they will buy the shorts at a very discounted or a reduced price. Okay, because when market is going up, put option price will reduce, right? So it will be very cheap value. Then they'll buy those, and with the intention to sell those massively bought stocks and futures which were bought early later. Okay, so they'll buy all this short position. They'll take a large short position in the options market. Okay, and okay, buying puts or selling calls, either they could do, and uh, and they know that the profit will drop for sure. So this is knowing the profit, knowing the future, or creating the future. You can create the future also. Okay, so future is created by human beings only. Uh, yeah, so yeah, so basically you're creating the future here. You know the future, that's what's going to happen, and that's why you're buying all these short positions in bank nifty, even though the market is going up at a very reduced price. Then once you buy these and your positions are set, what you do is you sell all those stocks and futures aggressively now. In the once you bought and your positions are intact, options positions are intact, then you go into the cash market and the futures market, and you sell all those stocks and futures aggressively. And obviously, when such a big sell happens, the index will go down, and with that, the put option will rise in value, and options prices will rise drastically compared to options has that advantage that when momentum is in your direction, the price will delta will help you to get the benefit out of it, right? And then they'll maximize their profit from their bearish positions. So for example, if you see on what SEBI has found, this is again from ChatGPT and SEBI. I'm just reporting it. So on January 17, 2024, they bought 4,370 crores of Bank Nifty stocks and futures early in the morning, which is 15 to 25% of the market volume. Okay, so that's 25% of the market volume. Okay, one player is playing. Okay, and what they did is then they reversed. Okay, and then basically once it took the options, then what they do is they'll just sell those 4,000 stocks, basically 4,370 crore stocks. They'll sell it, and they made 735 crores profit from options. Okay, despite taking 62 crore loss in the cash and futures market. So you'll incur losses here because you bought when the price is going up, and when the price goes down, you will incur losses in the cash market. But cash market, you'll incur losses. But since in an options market, your put will rise drastically. You will make more money in the options market compared to the loss you make in the cash or the futures market. So if you see, 735 minus 62 is the profit on a single day. So that's one thing that was found. Basically, you take a large cash position in the constant bank nifty index, then you buy the put options at a cheap price, and then you sell the cash position, and then you profit from the put option increase, and the net you will net loss from equity and futures market compared to the profit from options market. You are profitable basically. So that's what they were doing, and. And this is I think what was fine to them, 4,370 crores. The other thing they were doing is extending the extended market marking the close. Okay, so on certain expiry days, they were putting concentrated trades in the last 1 hour, so that the index will close at their desired level. Okay, which is critical for option settlement. Okay, by pushing it down or up based on their positions. Okay, if they have a position at for suppose 24,500, and if the market is at 24,300, then they will push it basically to 24,500, so that their positions are intact, or 24,600. If they have a position similarly on the downside also, they'll do. So that's on expiry days all this was being done. Okay, so all this intraday index manipulation, and when extended marking the close. So coming to scale of profits and the fine, Overall gains which the Street made is 36,500 crore total, and 43,289 crores rupees from index options alone that Jane Street has made, which is offsetted by 7687 crore loss in cash and futures market. Okay, so index they are making 43,289 crore profit, and the cash market they are losing 7687. Totally they are making 36,500 crores in 2 years. Okay. Yeah, so SEBI's interim action, they impounded 4,843 crores, which is held in escrow pending final verdict. So, what are the trading strategies they were using? We discussed this in detail. Morning, they'll buy a lot of stocks or futures. Then they'll, options positions they'll open after that. Bearish options they will buy at reduced price, and then they'll dump in the afternoon. They will because they bought these stock options futures temporarily. It raises the index and cheapens the puts. Okay, afternoon they'll come and they'll reverse this position. They'll sell all these stocks futures, and they will hold options through expiry. Index falls and options prices will surge. And at the close of the market, they will execute the mark the close trades. They'll drive the market to their price, which will finalize their options value and pushes the settlement risk. So this is described as a deliberate manipulation, and affects index fairness and retail investors' trust. Comparison of their India versus global revenue. So from India, they made 36,500 crores profit, and virtually all from Bank Nifty index options only. Global scale, they in 2023 their net trading revenue is 10.6 billion, which is around 90,000 crores. Okay, India profits equate to 40% of Jane Street's full year global profit. Okay, so India's profit contribute to 40% of Jane Street's full year global profit from just one product, which is Bank Nifty index in one country. So this makes that India strategy a major revenue line for them, although it is controversial now under legal fire. So why SEBI has taken action? Because there is a regulatory breach. SEBI labeled this strategy as manipulating and violating its PFUTP rules. Retail harm: 93% of Bank Nifty option retail participants for losing. Anomalous correlation correlation was found with Jane Street gains. Yeah, and market integrity threat is there. Their activity span 15 plus expiry days, not just one-off anomalies. So they were doing this consistently. Not one day it happened. They were doing this consistently, 15 plus expiry days. So that's a deliberate action basically. Summary is fine of 4,843.5 crore frozen after service interim order. Strategies they were using were big intraday directional trades to manipulate Bank Nifty, pump and dump cash futures to profit on options, market the close tactics on expiry settlement. Scale India based profits comprise 40% of Jane Street's estimated 23 global profits. Now, the outcome is they are banned from Indian market funds until legal resolution. SEBI pursues market fairness and investor protection. They're back because they deposited the money, they're trading. Okay. They're back. They're not completely banned. They were banned for a few days, but now they are back. Okay. But they do make money from market making also in other countries. Market maker is one who makes money from the bid and ask spread. Okay, so but also they do. They're a prop firm. They are not a hedge fund. They manage their own money, not clients' money. So that's it, guys. So yeah. So after this, we'll cover. There is an algo firm, Sticks Markets, and it exited the Indian market because Jane Street. They saw the risk reward profile being changed further. So after this we'll go through that particularly. So that's on Jane Street, and they are SEBI fine on them what they were doing, and yeah, as per the news and Chat GPT, I'm just reporting this. Thanks everyone for the call. Have a nice day. Bye.